Hi there, everybody. I'm Jenny Clark, the GovCon CFO with Solvability. And today we're going to talk about pricing strategy in federal contracting. I want you to stop guessing and start knowing. I'm sharing with you today the magic formula that determines whether you win a contract and make money or win a contract that makes you constantly worry about cash flow. That magic formula is your wrap rate. At the end of this session, you will know exactly how to use the magic formula to calculate your wrap rate, and you will never have to guess on a proposal again. Three questions for the room. Answer these out loud, in your head, in your car, at your desk, wherever you are right now. Have you ever opened the proposal workbook and wondered what percentages to use? There's so many numbers in those workbooks. There's sheets that tie together. They're linked: hours, employee rates, labor categories. Those percentages for fringe and overhead and G&A and fee. Are you still using the indirect rates from the last proposal that you did? Have you ever started a contract and then the people won't accept the job offer? You bid a contract several months ago, maybe a year ago. You got started, you hired the people that had already committed. Those people, a few of them leave, and you're recruiting, trying to fill those positions. You're making job offers, onboarding them, and people aren't accepting your job offers, or a prime is poaching all your people. Are you pricing low out of fear and then struggling with cash flow? It's a real gut punch when it happens to you, but you are not alone. And you are exactly who this session was made for. Meet Katherine Johnson. Katherine Johnson was a mathematician at NASA. Her calculations had to be precise, had to be exact, not close, not good enough, not a reasonable estimate, exact, because lives depended on the numbers being right. Understanding and managing your wrap rate gives you superpower, just like Katherine Johnson. You don't guess, you don't round up and hope. The numbers protect you and your profit. This equation is running in your business right now, whether you know it or not. The only question is whether you're managing it or it's managing you. The math protects you and your profit. Katherine Johnson wasn't just calculating trajectories. She walked into a room where people looked past her, where people underestimated her, where people doubted her, where people limited her. Her results were undeniable. With the precision of her work, nobody could argue with the math. We all know that feeling, having to be twice as prepared, twice as professional, twice as precise, and still fight to be in the room recognized as the experts that you are. With what's been going on with our federal workforce, so many jobs eliminated, so many careers disrupted. Too many of those in the federal workforce were Black women who were qualified, who were exceptional, who were committed, who showed up every day. Katherine Johnson matters because math was the proof. Your math needs to work for you in the same way because you deserve to be paid what you're worth, not less, not approximately, exactly what you're worth. And I will show you how. The secret to profitability in federal contracting is master your labor cost. Just like in real estate, it's location, location, location. In services contracting, it's labor, labor, labor. It's how you manage your workforce. It's having about 80% of your workforce be dedicated as billable resources to your federal customers. Your billable, your direct employees generate the revenue, and using this 80-20 rule of thumb, you're making sure that you've got enough people generating revenue to cover all of the indirect costs, including your back office, your overhead, fringe benefits, all of those costs, so that you stay profitable. You want to follow that 80-20 rule, keep track of what your labor utilization is, and have a dynamic model that helps you track where you are and what those rates are. Let's talk about a wrap rate, a billing rate. A wrap rate is the hourly billing rate you charge your government client. It wraps together every cost of doing business plus your profit into billing rates by labor category. Miss any one layer, and you're losing money on every hour that you bill, and you're locked in with low rates for the life of the contract. Fringe, overhead, and G&A are also called burdens. Layer one is your direct labor, the employee's base pay, annual salary divided by 2,080 hours, annual salary divided by 52 weeks per year at 40 hours a week. Layer two is fringe. Fringe is payroll taxes, workers' comp, holiday, paid leave, group health insurance, 401k match. You control the benefits package and the cost, so be competitive. But watch out for generosity. Retaining employees and balancing demographics is critical. In today's federal market, one of the only areas that I've seen people have ways to save money, ways to cut costs, ways to become more profitable is managing that benefits package. Layer three is overhead. Overhead is the cost of supporting your technical workforce. It's recruitment, it's managing clearances, it's CMMC compliance, it's skills certification, it's attending preferred partner statuses, like becoming a preferred partner with Amazon Web Services. Layer four is G&A. G&A stands for general and administrative. General administrative is executive time, your pay. Accounting, legal, HR, corporate insurance, proposals cost, business development. Layer five is your fee. That's your profit applied on top of everything else. This is what generates the cash flow you need for reinvestment and growth. It's your paycheck. I want to share with you a wrap rate calculator. This is on my website. It's solvability.com if you want to check it out. You can type in your own percentages and see what your wrap rate comes to be. You can also change those percentages and say, my gosh, if we were to change our G&A rate up or down, what impact does that have on our overall pricing? In this example, to keep things simple, I used a fringe rate of 21.58%, 2% for overhead, 12% for G&A, and 8% for fee. So it would come out mathematically to 1.50, so I could use a simple example when I'm doing math. I want you to be able to do the math in your head. Here's how the calculation works. On the right-hand side, you can see that I've got a little Excel spreadsheet display. I have $1 worth of direct labor. I'm applying 21.58% fringe. That's 0.2158. Overhead is calculated as the overhead percentage of 2%, times those two numbers added together, direct labor plus fringe. 2% of 1.2158 is 0.0243. G&A, general administrative, is spread across all of that. So the G&A percentage of 12% times direct labor plus fringe plus overhead, 0.1488. My total cost then is 1.3889. On top of all of that, I apply 8% fee. The result is a labor multiplier of 1.50. Here's how that multiplier gets applied. If I have somebody that I've hired, they're making $100,000 a year, that's about $50 per hour. I take the $50 per hour and I multiply it times my multiplier of 1.5. That gives me a billing rate of $75 an hour. For that person making $100,000 a year, when I bill my customer based on those percentages we just put in for fringe, overhead, and G&A and profit, my bill rate has to be at least $75 an hour. Let's look at it the other way. I've got a contract. It has labor categories, has descriptions of who I need to hire based on the credentials listed in the labor category. I know that that billing rate is $75 an hour. I take 75 divided by the multiplier of 1.5. The pay rate is $50 an hour. That means if I can hire somebody for $50 an hour or less, I'll make my intended covering the cost and getting the profit. Otherwise, I won't. I'll lose money. What would happen though if my multiplier actually went up? If instead of hitting 1.5, my overall wrap rate increased by 5%. That would mean that my multiplier would go from 1.5 to 1.575. Let's check the math on that. $75 an hour divided by 1.575 gives me a pay rate of $47.61. So I'm losing $2.39 an hour. Every hour that person works, well, overrunning your rates by just 5%. Imagine the impact across all employees and all contracts over the term of the contract. So if you do go to my website at solvability.com, my wrap rate calculator is available free at solvability.com/wrap-rate. Enter your fringe, your overhead, your G&A, and your fee percentages, and watch the multiplier update in real time. What you watch just takes about 10 minutes with your own numbers, 10 minutes that could change every proposal you submit from here forward. If this is something that's valuable to you and you want more information, here's my personal cell, 256-882-6276. Text CFO, your name, and your email address. I want to make sure that I can send you something about this session and follow up with you personally. I have created the wrap rate guide, which is a summary of exactly what we just talked about. And I'd like to be able to send it to you. So text me at 256-882-6276 and let me send it to you. Yes, that was the magic formula. That's the wrap rate. And that's where we start in government contracting, understanding the math of how a billing rate gets calculated. This is foundational to what I'm going to talk about right now, which is the concept of having a way to use a model that also forecasts what your rates are over time, where you are today on actuals, where you'll be by the end of the year, and how to bid out for future years. I call that the RPM, the rate and pricing model. Once you have your first wins and you've got some momentum, the rate and pricing model, RPM, is what takes you from reacting to directing. It tracks your actual indirect rates. It forecasts year end. It monitors profitability contract by contract. It tracks your actual indirect rates. And that's where you know exactly where you are. You stop guessing and you start knowing. This is not a spreadsheet you hand to an accountant. It's the tool that you use to decide which contracts to pursue, which to walk away from, and how each win builds towards something larger than the contract itself. The contractors who put RPM in place early scale without chaos. That is what intergenerational wealth looks like in federal contracting. Not one contract, a system. I've used the RPM for years with my clients. And let me talk to you about one that I started working with in 2017. Amelia was the bookkeeper. We started working together. She would send me the financials. I would take that information and I would update the rate and pricing model and I would send it back to her. That was 2017. By 2023, the company had tripled. Amelia's actually taken over the rate and pricing model, the RPM, and she's built out forecasts. She's added pipeline. She's added cash flow and even tax estimates in it. She's taken over other reporting that I was working with her on, such as the incurred cost submission. This is my goal, growth and succession. Today, Amelia owns that CFO role. That is the legacy. And that's what I want to help you create. Remember when Oprah was out on stage and she said, "You get a car and you get a car and you get a car." I want to celebrate you. You get a contract, you get a contract, you get a contract. When you win a contract, let's make sure you're getting paid what you're worth. Financial clarity is economic empowerment. When entrepreneurs understand their numbers, they build businesses that sustain families and communities, and they have choices. That is why Katherine Johnson matters. That is why the math needs to be right. The next step is to book a free discovery call. Here's my QR code. Don't leave money on the table. Get paid what you're worth. Apply the magic formula to know your wrap rate and manage how it changes with growth. Thank you so much for listening today. This is Jenny Clark with Solvability. You can visit my website at solvability.com. That's SOLV and the word ability. Would love to follow up and have a conversation with you about how we can help you grow your GovCon business.